Welcome to today's Explainer. Look, we're cutting through the retail market noise today. We are putting on our Tier 1 investment bank hats because we are diving deep into the August 3rd, 2026 Daily Strategy Report. This isn't your casual market recap. We're looking at the cold, structural macro realities that are actively driving global asset pricing right now. If you want to understand the exact mechanics of capital flows and how institutional money is positioning itself today, well, you're in the right place. Let's get to work.
Here's our roadmap for today. We'll kick things off with macro foundation and policy, then move into capital and rate dynamics. After that, we'll dissect the equity microstructure, apply our global noise filter, walk through a couple of strategic action scenarios, and finally, deliver the final verdict.
All right, part one, macro foundation and policy. We're talking about the illusion of relief versus structural reality.
The absolute biggest story today is a really dangerous divergence between what the surface-level data says and what the underlying economy is actually doing. Take the headline Q2 GDP growth. It came in at a deceptively weak 1.5%. Naturally, retail algorithms sold off immediately on that headline. But, we have to look under the hood. Real final sales to private domestic purchasers, that actually surged by a surprisingly robust 3.9%. And on top of that, we saw a massive 8.4% jump in business fixed investment. So what does this tell us? It tells us the AI infrastructure build-out is acting like its own independent engine right now. It is literally shielding the core economy from the headline weakness driven by trade deficits and government spending cuts.
We're seeing a very similar optical illusion over in the labor market. June payrolls came in incredibly weak, adding just 57,000 jobs, which totally missed consensus. But then, the unemployment rate simultaneously dropped to 4.2%. How does that happen? Well, it's because the labor force actually shrank by a massive 720,000 people. Let's be clear, this is not a quote-unquote strong labor market. It's a structurally tight one, strictly constrained by a shrinking labor supply. Corporate America isn't exactly rushing to hire right now, but crucially, they aren't firing either. And that brings us to the elephant in the room, the structural headwind of monetary policy. Fed Chair Kevin Warsh was pretty blunt, stating, "Prices are too high. We will deliver price stability." Now, the Fed did hold the target rate at 3.50 to 3.75%, but the real signal was in the voting. 3 officials actually dissented because they wanted an immediate hike. Listen, the Fed put that comforting little idea that the central bank will just swoop in and rescue markets at the first sign of trouble, yeah, that's dead. The bias right now is structurally hawkish, and institutional pricing models are desperately trying to digest that reality as we speak.
Moving on to Section 2, Capital and Rate Dynamics. Let's analyze the true cost of capital. To really understand this hawkish shift, we have to look at the bond market and see how it's draining global liquidity. Look at the absolute levels here and the aggressive steepening of the yield curve. The 2-year is sitting at 4.38%, the 10-year is spiked to 4.74%, and the 30-year is breaking through 5.12%. This aggressive upward shift, it's a massive flashing signal. It's actively testing the profitability of the banking system, and it firmly prices in long-term inflation fears. Simply put, the bond market is completely rejecting the equity market's soft landing complacency.
But here's the most brutal metric for anyone running a valuation model, the real interest rate. Take that 10-year nominal yield of 4.74%, subtract the 10-year break-even inflationary rate of 2.27%, and you get a brutal real interest rate of roughly 2.47%. This is acting as a massive, invisible tightening mechanism on actual financial conditions. Any long-duration asset that relies on future cash flows is structurally fighting gravity against a 2.47% real rate right now.
Let's dive into Section 3, Equity Microstructure. It's time to diagnose concentration risk and market divergence.
So how are all these macro realities showing up as the S&P 500 bumps up against that 7,600 level? Well, we are diagnosing some severe concentration risk. Just look at the extreme 900-point divergence in Wall Street year-end targets. On one hand, Goldman Sachs is modeling a super aggressive 8,100 to 8,250 target, betting the house on sustained earnings growth fueled by the AI infrastructure boom. But on the exact opposite end, Bank of America is modeling a severe drawdown to 7,100, citing mounting macro risks and serious valuation constraints. This historical lack of consensus tells you everything you need to know about the underlying fragility in current models. Literally no one agrees on what $1 of future earnings is actually worth today. And we are watching this valuation friction play out in real time with mega-cap tech.
Amazon just crossed a historic $3 trillion valuation, rallying 4.6% as their high-margin AWS segment continues to shine. But then look at Alphabet. Their shares just dropped 7% despite strong revenues. Why the massive divergence? Because Alphabet raised their capital expenditure guidance without showing immediate margin expansion. The institutional mandate has completely shifted. Investors are violently rotating toward visible, immediate free cash flow. If you're a company writing massive checks for AI without proving a near-term return on investment, the market is going to punish you hard.
Which perfectly segues into Palantir's absolute blowout earnings. They posted Q2 adjusted EPS of 41 cents, completely crushing the 35-cent estimate. And that was driven by a staggering 150% year-over-year surge in U.S. commercial revenue. This is institutional capital moving right before our eyes. We're seeing an aggressive rotation down the AI value chain. Money is flowing away from the abstract and into the picks and shovels. The company's demonstrating tangible, scalable enterprise adoption, or, as Palantir CEO calls it, AI sovereignty.
That brings us to Section 4, Global Noise Filter. Let's separate the actual signals from the geopolitical distractions.
For the portfolio managers listening, your number one job today is separating signal from noise. You need to impartially dismiss all the highly charged domestic feuds, the public sparring over pandemic policies between figures like Governor DeSantis and Dr. Fauci. That's political theater. The intense debates over border enforcement and military deployments in the English Channel or the Spanish enclave of Ceuta, also noise, at least for our specific pricing models. You absolutely have to ignore the theater and only track these events for their structural impacts. Are they altering regional sovereign risk? Are they hitting the local labor supply or triggering localized market volatility? If not, ignore it.
Now, let's apply that exact same filter to the energy markets. Over the weekend, oil prices dropped a massive 8% on diplomatic peace hopes regarding Iran. Okay, but let's cross-validate that against physical reality. The Straits of Hormuz remains completely paralyzed. Ships are literally still turning back. So that 8% price drop, it's just an illusion of relief driven by short covering. It is not a structural fix to global energy supply lines. As long as the physical supply remains choked off, the fundamental pricing risk is still heavily tilted to the upside.
And while the entire market is fixated on oil, they're completely ignoring a true underpriced black swan risk. We are tracking a growing wave of cyber attacks targeting domestic U.S. water and infrastructure utilities. Federal officials are pointing directly at state-sponsored actors, specifically Iran, who are leveraging advanced AI models to rapidly accelerate their offensive hacking capabilities. This is an asymmetrical warfare tactic, and frankly, traditional volatility metrics are completely mispricing the threat right now.
Let's move to Section 5, Strategic Action Scenarios. It's time for some binary portfolio directives.
All right, we've laid out the macro realities. Now it's time to talk execution. Our models dictate two strict binary paths for institutional positioning. First, Scenario A, the bullish breakout. This requires the U.S. consumer to keep up their current spending trajectories despite the high rates. If we get confirmation there, your directive is to overweight AI industrials, those picks and shovels we talked about, and ride the momentum ETFs. But then there's Scenario B, the bearish breakdown. This is triggered mechanically if that 10-year real rate sustains above 2.6%. If we breach that threshold, the directive is immediate. Underweight all long-duration growth assets and initiate aggressive downside hedging, because at that point, valuation multiples will just mathematically collapse.
And finally, Section 6, the final verdict, navigating the new paradigm.
Let's wrap this explainer up with our overarching judgment. The bad is good era, that time when weak economic data just meant automatic central bank bailouts, that is officially dead. The Fed put is gone. Moving forward, portfolios have to be aggressively stress-tested purely for real, immediate free cash flow generation in a persistently high-rate environment. The illusions of relief are fading fast, and structural math is taking over the wheel. So I'll leave you with this. Is your current portfolio actually built to survive this violent return to macroeconomic gravity? Thanks for joining us for this explainer. We'll see you next time.